Good afternoon, folks. Hopefully everybody can hear me just fine. This is Mike Kinnett. Ryan is remote today at his house, tuning in as we speak. We just wanted to kind of give you guys an update of what we see, what we're thinking, some of our concerns. We've seen the market kind of go up and down a lot over the last couple of weeks, and you know, as we got that little bit of a rebound, lots and lots of phone calls about shouldn't we be fully invested now? Should we be back in the market? You know, the market's going crazy. We just wanted to kind of have that conversation just to see where we are right now. You know, obviously, for new people that are listening in, this is pretty much our team. A couple new people that aren't there yet that you'll meet as you become clients. And for those of you who are already clients, hopefully you've had the opportunity to talk to Allison and Lawrence over the last couple of weeks as we try to figure out this remote lifestyle that we're all in now. This is Ryan and myself, our Hall of Shame, our Wall of Shame. And I just want to point out that Ryan was notified by Forbes that he is in the one top of the quarter percentile of all financial planners in Maryland, which was pretty impressive. I was pretty pleased with that for him. Pretty proud of him for that. All right, let's see. So obviously everything we're talking about, no crystal balls. This is things that we see, things that we are our impressions, our takeaways, and everything is subject to change because, of course, the markets are changing and factors are influencing things in a way they've never influenced them before. So I just want to make sure we keep that in the back of our mind that as we say things today, that tomorrow when they announce something new or different, I mean, obviously if tomorrow they come up with a vaccine, half of the things we're talking about today are completely irrelevant because the rules and the facts have just changed. So keep that in mind as we're talking about this stuff. I do want to point out what has happened in the past with former epidemics and pandemics. You know, we've seen the market get volatile, but we've always seen basically within a year, for the most part, the market has always come back in a positive manner, typically within a year of the end of the pandemic. So of course that is the tricky part. When exactly does the pandemic end? Is it going to end in April or May when the season changes? Is it going to come back in the fall? I mean, all those things are the unknowns that we're all dealing with. But even here, you can see that over time, that as the markets have gone through SARS and through the dengue fever and the swine flu, everything, even though there's been dips in the market, within a year, the markets have almost exclusively across the board within a year have always come back over time. So we do want to keep that in mind as we're thinking about these things. And this is what's happened in the last, you know, first half of this year coming into the fiasco that we find ourselves in now. You can see there that the WHO here, and hopefully you can see my pointer, that when they announced the problem, you know, initially we had that drop at the end of January, and then it came back up. And then once it started to really show its ugly face here in the United States, that's when we saw this huge drop off on the side. And we think that, you know, just again as background, just to kind of bring us back into view, you know, we think that we're getting close to that flattening stage ourselves. And if we look at what happened in China, we can see here that it takes off, and then it's finally at some point about 30 days later from the time they started to isolate. And I remember I was down in Florida doing the Super Bowl stuff, and we haven't posted all the interviews that we've done, and at some point we'll get back to doing that. But we were down in Miami for the Super Bowl, and we had heard right there the week before Super Bowl that they had actually quarantined 60 million people in China. Think about that, quarantined 60 million people, and that's what it took for them to get to that flattening stage. And and that's actually what this represents, is that flattening stage that we wanted to see. And taking into consideration that from that point on, and now we see China opening back up. They've released those 60 million people. Factories are starting to come back into play. Production has started to come back to play. Even American companies are reopening stores and stuff in China now, because from the economic perspective, China closed down enough and is ready to come back for business. Now, if you think about it from start to finish, they really started this whole process early January, and here it is the middle of April, and that's when their markets are starting to open back up again. So start to finish 4.5 months for them. So from our perspective, we should see something comparable. We started ours, even though we had some early reports earlier in the year, January into February, that we started to see some reports. The thought is that at least at that time it was we were being told that it wasn't going to be widespread, but clearly about the first and second week of March, we started to get a better feel that perhaps things were going to be a little bit more squirrely than we thought. This is the new cases of COVID being reported in the United States. You can see here, the outbreak begins basically in end of February. End of January is when we started seeing them out in Washington State. It starts to spread. Here in Maryland and several states, somewhere between the 5th and the 10th of the month, they started telling us to stay home, start doing social distancing. Somewhere around the 18th or 19th, the White House starts following the social distancing protocol, and we can see basically from that time forward, if we think about from when we started it in Maryland, when we started it in New York, when we started in half the states, it was sometime right around the middle of March. So if we go 30 days forward to basically this week, this is the week where we should see the worst scenarios happen, and we should be seeing flattening by the end of this week. That's what we hope to see. And, we've heard some reports coming out of New York that they seem to have flattened in New York as well. And of course, there's other parts of the country that didn't take the same steps as early. Florida notably waited till basically, I'm going to say the beginning of April to start social distancing, at least closing up the state. Didn't happen until really the beginning of April. So clearly they're going to be hit a little bit harder, and coupled with their older population, because as many of us know that Florida is God's waiting room. We think that they're going to have that flattening effect a little bit later, closer to the middle of May for them. So just taking into consideration that the whole country is not going to flatten at the same time. There's going to be regions, which is why I suspect that President Trump is talking about opening up regions. There'll be regions that flatten a little bit sooner. This is what we look like now. Are we flattening? And this is as of Saturday. So are we flattening? And it appears that curve there appears to suggest that we are in that flattening stage. And if we go back into earlier this month, or actually middle of last month, in the middle of March, we did a webinar and talked about the fact of flattening, and we were using Italy and France and Germany as examples, and they did exactly what we thought. You can see they flattened a little bit earlier than we flattened, which is okay because they started the process a little bit earlier. But given the fact that they're a template, Spain's just started to open up stores again, to push people out into the public scenes again. So we know that 30 days roughly from quarantine, from social distancing, about 30 to 45 days later is really where you see that flattening happen, and that seems to be the case here. We can see the date really. We know that we started seeing the onset, where we started to see the spread early February, which means, like I said, we think sometime this week to early next week we should see the flattening. And you can see in the market here, this is the whole drop of the market because of the pandemic being announced and the whole quarantine and self-isolation. And then right here is where the bailouts were announced. So that's why we've seen a little bit of bouncing. Now, the problem with some of the bailouts, of course, is that, well, they've been problematic in rolling out. We're going to talk a little bit more about that as we move forward. We can see and by the way, folks, I don't know if I said that, but there is a spot where you can ask questions, and if you want to ask questions, you can put them in there. I will get to them at some point, maybe as we go, but I'm trying to focus on the presentation, not necessarily questions. But I will come back to questions as we progress. We can see here that this is the S&P 500 during the last economic drop, and I emphasize economic because when there's an economic drop, we can look at certain things in the economy. We can look at certain technical indicators. We can look certain fundamentals, we can look at things that will give us guidance as to what, why, and how. The drop we've experienced thus far has been more related to the emotional side of things. And yes, looking forward, there are other things that come into play in the economy, but those are 3 to 6 months down the road. So I think we're dropping too early for that particular issue. But nevertheless, you can see that we've had these drops. You can see we had this drop in 2003, the bubble, when the bubble burst, and it was a pretty significant drop. And you can see along the way we had these little bounce backs. Right there's a little counter bounce back. Here's another little counter bounce back where we drop further, bounce back up. And here's another one, and here's another one. But at the end of the day, we still kept dropping and dropping and dropping. And we're going to talk a little bit more about resistance lines and support lines. And we can see here that each of these drops, this drop and this drop and this drop and this drop, were all further drops. And it wasn't until we started seeing this upside, and this upside that we could see that we were actually starting to see a little bit of rebound in the upside and give us a little bit more support moving forward. And I'll show you a little bit more about what I mean there. Here's our drop here in the 2007 to 2009 housing bubble crash. Again, you can see these oops, sorry about that. You can see these bounce backs here. We kept having these counter turns here, but they never held. And then this is basically going right into the election, right before the election happened. And then when we finally bottom out, it's just an absolute mess. And I think everybody remembers that. It wasn't until March of 2009 that we actually started to see that support moving back up. So this is our drop now. And we have the same problem. You can see it. You can see the huge drop down. You can see these little counter flares where we're trying to pull back up, trying to get back up into the market. And right now, what this is happening here, what this is going on here, this is 100% related to the bailout questions, right? Are we going to have a bailout? So what I wanted to show you, we're bringing in some technical indicators, and there's a philosophy. It's just something that we use. It's a tool. It's not an answer, because obviously if it was an answer, we would have the answer 100% of the time. But there's a rule of letters, and one of our clients has actually talked to us about it before. They're called Fibonacci rules, and they just have to do with multiples of certain numbers. I said letters, I meant numbers. They have to do with certain numbers, how they have a tendency to, appear in certain mathematical equations, and the stock market's no different. And you can see back here, this is the 2000 to 2003 drop, and you can see each of these counter trends trying to come back up. And what we see here is that from here to here is a 50% drop. But once we had that 50% drop, it tries to come back up, but it can never quite get back above that 50% drop line. You see this, the 100% to the 50%, it never gets up there and holds, and then it drops again, and it tries, and it drops again, and it tries, and it drops further. So that's kind of what we're talking about, this counter trend, and that's what we're worried about happening right now. This is the 2007 to 2009 crumble. You can see the big drops. It tried to bounce back, it couldn't. It tried to bounce back, it couldn't. We had to wait till we got all the way down here before we saw it. So this is the 2001. This is the 2008. The question is, we know history doesn't repeat itself, but it sure has a theme to it, right? What's it say that history doesn't repeat itself, but it sure rhymes? That's what our concern is here, that we're going to see this counter bounce come into play here. And we know, it's interesting, and this is where that Fibonacci rule comes into play, that 8 weeks. So if in fact we agree that the bottom was the 24th, that means sometime around the second week of May, we should see that bounce. And if we look at what's going on now, this is what's happening now. Here's our 24 down to the bottom, right? So this is our big drop from the volatility of February coming into March. Here's our drop. Here's the bottom, right? I think we're all in agreement that we've seen the bottom. And the concern is this in fact the counter trend? Is this that bounce that we've talked about happens? And sometime around the middle of May is when we should see it drop back down again. It doesn't mean it's not going to be volatile. It doesn't mean it won't bounce around a little bit, but The key here is, see that number right there, that 2,800? That represents our 50% mark. That's a very, very important signal to our team as to when we think that we have actually that support that we need. If we can get above it and hold it, that's the important part. And you can see right here, you can see we've hit it a couple times, but we just can't hold it. And every time we hit it, it comes back down. Every time we hit it, it comes back down. That's the problem we have. So when we look at these little bounces up, they're just not sticking above like we need it to. And what we actually see, and this is the part that makes us nervous, what we actually see is this: the green line. See how that bottom hits and then it comes back up and it goes down further. It goes up, but then it comes down further. That's bad. That's a bad indicator for those of us that follow the technical side. And even on the top side, you can see the highs are getting lower. Even though we have a little bit up here, we have a little bit up here, we have a little bit up here, the highs keep getting lower and lower and lower. That's problematic. That's what leads us to believe that we may not have the rebound that we're expecting, that we may not be out of the woods, which is why we're not 100% invested out. We have somewhere between, a portion of your money is for the clients that we actively manage. A portion of it is in, gold and bonds and those type of things. Then we have a portion of your money in the stock market, but it's less than 50% for most of our clients, even at this point. We do want to catch some of the upside, but we still have some concerns that this whole thing could roll over and die mid-March. And another thing that as we're talking with our clients over the last month or so, it's a reoccurring theme that comes into the conversation about what does the market actually average over time. And there's this, we hear all the time that the market averages 8, 10, 12%. You hear that all the time. And I think that's a true statement if you can buy and hold for 60 or 70 or 80 years. But I don't have any clients. I don't know anybody that doesn't need their money for 60 or 70 years. And that's what it takes to make sure you have those type of returns. Because what you see here, this is January 1st of 2000 to Friday. Friday's close on the market. Or I guess Thursday's close on the market. But this is the return that you have during that time period. 3.17%. So buying and holding for 21 years roughly, you had a 3.17% rate of return. Now, when we show you these graphs, obviously you can't invest directly into the S&P 500. You have to buy an index. So, you could have some variances there. And the S&P itself, when you're looking at the graphs, do not include dividends, but the average dividend rate for the S&P is around 2%, just a little bit over 2%. So if you think about it, 5.5% is the average rate of return that you've experienced. If you just bought and hold the S&P 500 for the last 21 years, you had a 5.5% return. And for 13 years, you made no money. So when we hear about these 8, 10, 12% returns, yeah, you can do that, but that requires a buy and hold for a very, very long time. And for most of our clients, they don't have that, which is, frequently why we always allocate, we make sure our income is taken care of first, then we decide how much risk we want to take. And when we're doing that, for many of our clients, part of the risk factor that we take into account is we put a percentage of your money in the stock market and a percentage of money in fixed annuities in lieu of using bonds, because fixed annuities don't go down like interest rates can cause bonds to drop. And 2008, bonds dropped just like the stock market did. And about 2 weeks ago, treasuries lost 10% in one day. The whole market was crashing, but federal treasuries lost 10% in one day. Now, it wasn't that the stock market zoomed on that day and treasuries went down. Everything was dropping and bonds dropped as well. A fixed index annuity doesn't do that. So for us, when we're looking at the total portfolio for us and we're looking at the equity side, and if we included the bond side, which most people have equities and bonds in their portfolio, we're looking at it as how did your fixed index annuity do with your equities to give us that 5 to 7% return that we tell most of our clients to expect. I think this is another important thing to notice. About every 7 years, the stock market has a bear market where we lose around 40%. So think about that for just a minute. About every 7 years, it's reasonable to assume you're going to lose 30 to 40% of your money in the stock market. It's just the way it is. So if you're 62, if you're 60 to 65, you have 3 or 4 more of these bear markets before you pass away at 90, 95 years old. If you're 70, you have at least 2, maybe 3 of them. So as we are coming out of this market downturn, and we will get out of it at some point. Again, no crystal ball. I don't know when it's going to happen. We're going to show you some things here in a second. But keep in mind the risk that you're taking. You need to take that into consideration about how much risk I'm taking, and is it the right risk for what I'm trying to accomplish? And we'll talk with our clients with that over the next couple of months as we start to review what's going on and we do our springtime reviews. What's going on that's supposed to help everybody? Checks go out this week if you have direct deposit, which is nice, and put an extra $1,200 per person, plus maybe some money for kids, an extra $500 for kids. There are some income limitations, so you do have to be aware of that. The big thing is that, do you have direct deposit set up on your federal tax return? For some people, they owe money every year, so they never put a checking account into their tax return because they just mail the check off every year. So if you've traditionally owed and you do not have direct deposit information in, you are looking at somewhere, instead of the checks coming out this week to you vis-a-vis direct deposit, because that's what's supposed to happen over the next 2 weeks, sometime the week of April 24th is when they start to physically mail checks. Now, I was listening to a report the other day, and the report suggested that the IRS can print, I want to tell you, 10,000 checks a day, which they estimate will take them into the middle of September to get to everybody. So think about that. What is intended to help us through this very, very tight, difficult time of social distancing and this very typical tight time of reduced payroll for people losing their jobs. Some of those people may not see checks until the fall, and that is kind of what will kind of play into the emotional response that we see as the market starts to open back up, as the economy starts to open back up. We did do a newsletter, I don't know, sometime in the last couple of weeks, and certainly last week, this last week. We included a link in there so you can go find out how much you would otherwise be entitled to if, in fact, you have direct deposit set up right now. And if you don't, you can still find out how much you'd be entitled to. It just take a little bit longer to get to you. Unemployment, this is through last week, so it's at 4.4%. 6 million more people, 6.6 million more people applied for unemployment through the 4th. So the report you see on your screen now with that 4.4% right here, this does not include the 6.6 million people who just claimed, and we think we're going to get another 5 to 6 million this week. So just think about this. When this is all said and done, we could have unemployment in that 10% plus range, which would be worse than it was in 2008. Ryan and I, like all small businesses, went out and looked around to see what was available and what the application process was. And, Ryan, if you want the dirty details, Ryan can speak to it more than I did because he handled this side of it for us. But what opened up as, all banks were taking care of anybody who wanted to come in. By the time we got done with Friday, 2/3 of the banks had shut down their systems because they weren't prepared to handle the amount of loans that were being applied for. And most of the banks that we are aware of, and you can go to that website if you know people that are looking for loans, that website will tell you which banks are accepting and how they're accepting. But when I went and looked at that, at banks that were accepting loans, most of them are only dealing with their own personal business clients at this point. So, for example, Ryan and I don't use Bank of America, so Bank of America won't even consider using us as loaning us money if we wanted to apply for this. And we've been fortunate. Ryan and I sat down with our team, and even though we're doing everything remotely, as you all are aware, as you're calling in, you're leaving messages because the phones are hard to man remotely 24 hours a day. We're trying to get back to everybody in pretty short order. But we've been fortunate. We have one person coming in the office every day to handle mail, but the office has been completely closed since Governor Hogan closed it down. And knock on wood, none of my staff or their families have had any health issues so far. And like everybody else, we're going to be a little bit nervous opening our doors back up to the general public, just because, you know, the White House or Mr. Hogan says, you know, on May 1st, I'm just making that up, that we can open up our doors. We're still going to be a little bit nervous, and I suspect, you know, the consumers are still going to be a little bit nervous. But the point here is that this whole lending program that is supposed to keep businesses afloat, we all thought money would be being distributed this week, and at this point, you know, Ryan and I are fortunate we have heard back from our banks, but our banks sent us notices saying, hey, we got your information, we'll let you know when we're ready to actually talk to you. And you know, Ryan and I, we are a very, very large mom and pop. So, you know, we're not a small potatoes company where we have 1 or 2 employees. You know, we have, you know, year round, we have up to 17, 18 different employees at any given time. So, you know, we have a pretty large payroll. We have you know, all the offices that we're trying to keep afloat, keep everybody employed, and we're not unusual. There's a lot of people out there like us. Unfortunately for us, we deal with a small local community bank, and I think they've been a little bit more receptive. The March Federal Reserve Board, I mean, I just love this. Think about this. This is what Chairman Powell said, which it was just interesting that he would say anything at all. But he said that they're not going to give any forecast going forward because everything's in such upheaval and turmoil. We have no idea what's going on. It just doesn't seem to make sense to put anything into writing, which, if you remember at the beginning of this presentation, I said that, look, here's what we see today, but things are changing so quickly and so rapidly. By the time I'm done with this, six things could have changed the whole dynamics and whole presentation, which is also why we do this. If you go to our Facebook page, we are constantly posting things on Facebook. I would say once or twice, sometimes 3 times a week, we are putting things on our Facebook page. Once or twice a week, we're sending out emails. So if you're not going to our Facebook page to watch the webinars, to watch to listen to the podcast, if you're not doing that stuff, if you're not listening or reading the emails when we send them, please do so. Please do so, because we are giving you information on a regular basis of what we see, why we see, all that type of stuff. There's so much change. We are trying to keep you abreast of information as quickly as we can. This is GDP. So, you know, GDP, the actual announcements don't come out for a couple more days, but we think, you know, there's pretty much the consensus was first quarter we were already in a recession, despite the, you know, in spite of the COVID-19. So the COVID-19 had nothing to do with us being in a recession to begin with, but clearly with the way things have been working out with the closing down of all the businesses, it's easy to foresee and reasonable to expect a second and third quarter worth of possibly being in a recession again. And certainly the second quarter being in a recession should not be a shock to anybody, and it could last as long as into the third or fourth quarter. ISM report, one of the factors, economic factors that we look for. Anytime this drops below 50, this 49, anytime it drops below 50, that's a pessimistic view of what manufacturers think is going on in the economy. So we are definitely below 50, and that again is just an indicator to us that things aren't going to get better, and that line is pretty straightforward. It's going to continue to move down. We expect. Consumer sentiment, I mean, understandably it has dropped huge, but this will continue to drop. It was way over 100, you know, into the fall last year. So as we've gotten through the fall and into this and through the winter and into early spring, we've seen it drop basically 50 points. I mean, it was just absolutely crazy exuberance. And I'd like to point out also that the debt level we have right now as consumers is greater than the debt level that we had in 2008 when the markets were falling apart and everybody was having so much difficulty paying their bills then. And that's when people were still working and collecting salaries. I mean, yes, unemployment was high. So anyways, we think this number will continue to decrease, to deteriorate as people come to terms with the fact that they still have their bills to pay. And even though the lenders, from everything that we've seen for lenders for mortgages, they are going to tack the loan on the back end. So if you have, I'm just making up, if you have 36 months left on your mortgage and you can't pay your mortgage now and you want to defer it for 3 months, you'll then, you'll finish paying it off 39 months from now, because they'll just tack those 3 months onto the back end. Rent, right? I mean, some companies are saying you can, postpone your rent, but what's going to happen when the market opens back up and the economy opens back up? Are they going to let them, pay that rent a little bit every month? Are they going to make them pay it all at once? I mean, how's that going to be handled? And I think that's a concern that people will need to take into consideration. One of the things that Ryan and I look at, unemployment is an important number, but for us, this top chart represents people being willing to quit their jobs to go get another job. And for us, the fact that somebody's willing to leave something that was otherwise safe and secure, employment-wise, to give that up and go to someplace else, this is the quit rate now, which basically you can't even measure it. They are saying people are not quitting their jobs to the extent that they haven't been laid off already. They haven't been laid off already. They're not willing to leave their job to go get something else, and that tells us something important. And like I said, we know unemployment is at 4.4% right now. It's booming up. So we expect to see this somewhere in that 8 to 10% range. But the important part of it is to know is that we won't see the end of unemployment, the rise of unemployment, till somewhere 4 to 6 months after the end of the recession. So if we assume for just a minute that, April, May, and June, the second quarter is going to be negative, that we're going to have be in a recession still for the second quarter, that means that it won't be till the end of the year, beginning of next year, before we start to see unemployment ticker down and start working its way back down. That's a long time for people to be unemployed, especially during the holiday season. Oil prices, in the United States, and this is just another economic factor. Think about Texas and North Dakota, South Dakota, Oklahoma, and all the people that live off oil production. All those people, the United States needs oil somewhere between $45 and $50 a barrel to break even. That's just to break even, not to make money, but to break even. And even though they just said they just made the announcement over this weekend that OPEC and Russia have stopped beating each other up and they're going to work together. Oil prices aren't. Just demand is so low right now because nobody's going anywhere. Nobody can go anywhere. Nobody can do those things right now. So we think it's going to take a little bit more time before that comes into play in a positive fashion, that oil prices will start rebounding enough to make a difference here in the United States. And I just lost my mouse. So give me a minute. Where are you? There we go. Pulling it all together, if we agree on our measures to begin socializing, social distancing, and the whole quarantine process here in the United States, and specifically Maryland as well. If we agree that it happened around the 10th of March, right around there, we think that sometime this week is the week that we should see that leveling, and we've seen that. We see that evidenced by the different charts we've already shown you. We do expect more market volatility as the first quarter recession is confirmed and the slowdown continues into the next 2 and 3 quarters. And we think that the markets will have what's called a W-shaped recovery. We think that we're going to get this little bit counter trend, and it's going to drop back down further, and then finally pop back up into summer, and we expect it to start rebounding, in a more consistent manner. What we're looking for here, and we talked about this before, these are the tops that we want the last week. This is just this last week. And you can see these are the tops we want. This is the problem. This didn't get to here. These aren't getting to here before they turn down. And this 2780, 89, almost 2790, Um, it's now down again today, right? The markets, at least when we started this presentation earlier today, the markets were down, and I'm looking at them now. Yeah, the markets are down 1.5% right now for the S&P 500. This number here is now down to right about here. So this has taken a pretty big dip already today. We need these to start hitting this upper level. We need it to come up to this level and hold above that 2,800, where we're comfortable that in fact we have that rebound that we've been talking about. And what does it look like? I was actually having that conversation this morning and over the weekend with some people. You know, what exactly does opening the markets back up again, opening the economy look like when it happens? You know, so restaurants, when restaurants are opening back up, is their staff still there to help them? Can they actually bring their entire staff back in immediately? Probably not. What do they do about supplies? I mean, we already have a disruption in the supply chain, and some of it's just the nature of how supply chains work. But the reality is that these farm workers and these meat production plants, you know, Smithfield Pork just closed down their plants because of 50% of their workers have the virus. So what exactly does this look like? How do they get their inventories in? Where do they have the cash resources to get the inventories? Are vendors going to front all these industries, all these retail outlets for people to go out to? Are they going to front them the money for the inventory? I mean, how exactly does that work? You know, I don't know about you, but, you know, if they open up you know, if they tell me I can go back out into public and start socializing on May 15th, I'm not sure how comfortable I am walking into a restaurant with 100 people standing around waiting for a table. I mean, you think about that. And what's the reaction going to be for the general public? We assume that this is going to be a slow, gradual reopening. It's not going to be, you know, on all of a sudden on June 1st, it's open up. And, you know, we were just talking about the annual crab feast that we've been doing for years. I mean, even if the everything's open back up by June 1st, I'm not sure I'm comfortable having all my clients show up on June, whatever the second Saturday in June is, to come do a crab feast. We already know that about 80% of the people that get the virus, they don't have any illness, they don't have any symptoms, but they're carriers. And until they figure that out, until they tell us that they have a way to test everybody and or vaccine in place, and they're actually able to do those things, we think this is a slow recovery, a slow, gradual recovery. And as people get excited about the bailout, we saw the markets bounce up. We think the flip side to it is, as the reality sets in, that look, these bailouts are going to be a little bit more cumbersome than they thought it was going to be. It's not as easy as people may think it's supposed to be. You know, the way it was presented is that those checks will go out tomorrow and everybody'd have their loan in a week. But, you know, if you have a small business like Ryan and myself, and we have to wait 2 weeks, 4 weeks to just get approved, and even though we're approved in 2 weeks, if it takes another 2 weeks to get it funded, which isn't an unreasonable amount of time, you know, to get funding in 2 to 4 weeks after approval is reasonable. In the meantime, that's 6, 8, 10 weeks without payroll, you know, that we're draining our reserves to pay our employees. And I'm using the word "our" as a generic term. That's the business across the board. So, and even these guys that own restaurants that are bringing people back vis-a-vis the payroll protection plan, what are their employees doing, if anything? Right? Are these guys going to pay their employees, or are they going to take the risk that they have to pay tax on it later? And I'd rather just pay tax on a forgivable loan, or have to pay it back, than maybe spend all my cash, right? Because I still have to pay my own personal bills, and I still have to get my company up and running. You know, one of the reasons why Ryan and I actually applied for these loans was not because we couldn't, you know, that we were worried about laying employees off, although it was part of a conversation depending on how long things lasted. But it was also so that we had the cash resources to continue to move forward once things opened back up again. So, you know, at the end of the day, we have some concerns that just because they open up the economy on May 1st or May 15th, whatever it happens to be, doesn't mean people are out running and spending money. They still have concerns about how do they pay those bills that they're in arrears already, and how the businesses actually have the cash flow to start up again, to get the doors open again. We think the Federal Reserve will continue their versions of the quantitative easing to continue to try to keep liquidity into the markets. The federal government, we think, is going to continue to extend the bailouts. We think that that's going to be the process. Of course, Tweedledee and Tweedledum will continue to fight over how you control the money and who's going to actually spend it on. But eventually, they will send some more money out there. We already know that the portion that they set aside for the stuff that they set aside for us now is not near enough. I mean, it's just not near enough for the amount of people that are looking for the assistance. If you're looking for safety, cash, treasuries, golds, and if you think the market's going to continue to go down, inverse funds, those are possible plays to protect yourself during the drop in the market. Although, again, treasuries dropped 10%, when the market was diving, which was just crazy. And if you're going to use inverse funds, just know that they are very aggressive, and you can lose a lot of money in them if you use them incorrectly. So just be, go into them with some hesitation there. We think the return of premium fixed index annuities that we've used in the past, those 2-year ones, they're now 3 years for the most part, but they're still a viable play for a portion of your money, certainly for the next 2 or 3 years. And for the people that have them that we just did recently, the nice thing about it is you bought at the bottom of the market. I mean, we couldn't have timed it any better if we did it on purpose. So we actually got in at the very, very bottom of the market, which of course is the place you want to go in. It's always good to get in at the bottom. Always think about it, and it's always been Ryan and my philosophy. We always want to make sure that income is safe and secure. So for the majority of the clients listening, for the majority of our clients, your income needs are met by Social Security, pensions, and or fixed annuities. So your income needs are being taken care of. With rare exception, we know our income needs are being taken care of. So that gives you a little bit of comfort knowing that even though you may have some money in the stock market, that money is not needed for day-to-day living. I'm not saying to take it lightly. I'm not saying to ignore it. I'm just telling you that you have at least you have your income that's safe and secure. Think about those people that have chosen to take a 5% withdrawal from their investments every year to make their income needs met. And think about that 13-year period. You're taking 5% out. That's 65% out of your investments of 13 years of down and flat markets. You're running out of money. So for our clients, the majority of you that have followed the advice that we've given, we don't have that problem. So I just want to reassure you again that for the income needs that you have, the majority of you do not have that problem. You might start thinking about some if you have some money sitting in bank accounts, just money sitting around, maybe there's some cool stocks. You always wanted to buy Apple, or you always wanted to buy, Microsoft or something. Prices, things are on discount now. Start thinking about sometime in the next, 2 to 4 weeks that there might be something that you have on your wish list that you've always wanted to buy. Roth conversions, we did a lot of Roth conversions last year, and they still make sense for lots of clients. So, when you're having those conversations with Ryan and myself or Andrew, make sure you're talking to us. Do the Roths work for us? Do they make sense for us? Fortunately for us, for our clients, we do loss harvesting already, but you want to take advantage of any losses you may have in your portfolio now. And even though, for people that are listening that are not our clients, and even though you hear all the time, it's only a paper loss, or it's only a loss if you sell the position, if you own S&P from Vanguard, you can sell the S&P for Vanguard and recognize your losses, and then go buy the S&P 500 from Russell or from iShares or from somebody else. You can still own the S&P, but you can harvest that loss and salvage that loss for later, so you can use it to offset gains later when you need to, instead of waiting for that thing to come back. You're selling low on one side, but you're buying low on the other side. So that's just a way to take advantage of it. For the most part, we don't use mutual funds, but for people that have mutual funds, you do need to be aware that just because the markets are down doesn't mean that you won't get a tax bill come January, February of 2021. If you remember back in 2008 and 2009, people that lost 30 to 50% of their money in 2008 got huge tax bills from capital gains in 2009. This is the exact same scenario, which is one of the reasons why we try to stay away from mutual funds for the most part. And we've talked about this. I know if you Google annuities, the first thing that comes up is I hate them and you should too. And like any tool, for the right reasons, fixed index annuities are good tools. For the wrong reasons, they're disaster. So depending on what you're trying to accomplish, do not be afraid to look at an index annuity as a way to participate in the upside of the stock market without the down. And remember, I showed you that chart that said that, from 2000 to to April 9th of 2020, the actual S&P is right around 5.5%. If you include dividends, annuities, right around 6%. So think about that. None of the risk, 6%. You're about the same spot. It's just really trading liquidity for that guarantee, because annuities come with some liquidity issues. Our strategy, we're going to continue to DCA into the markets, meaning we're going to put a little bit more money into the market probably sometime in the next 2 to 3 weeks, mostly because we do want to catch some of the upside. Now, again, we're looking at factors every single day. So we may, I say our goal is to continue to DCA into the market, because if in fact if it doesn't turn into be a W, it turns into be a soft U, meaning the rebound is a soft U. Or if this Fibonacci does not happen, that we don't have this counter trend that actually drops again, if that turns out not to be the case, we don't want to be sitting on the sidelines the whole time. The flip side to it is, if we do have another drop, we do want to make sure that we're paying attention, and we will do that. We're going to be looking at things that consumers need to spend with the money that they have to spend today, right? It doesn't make sense to go out and buy a bunch of stocks related to discretionary spending, because most people today don't have discretionary spending. They're so worried about preserving what they have. We're also going to look at some places that have some recovery. I mean, healthcare probably is going to be a place to look at. Automobile is not the place to buy right now, but you know what? Come June or July, automobile industry may be a smart place to go. We will continue to watch the technical indicators that are out there, because we want to minimize that exposure to that double dip that we've been talking about. Virtual meetings, we're going to continue to at least May 1st. I think this morning in our group meeting, we think that we're actually going to push that out to May 15th at this point, because even if they do agree to open up the markets and open up the public again on May 1st, I think we want to just hedge against that oops of the person who carries it that doesn't know they have it, and for my staff and myself, we want to make sure we're protected, so that one, it is important that they're healthy, but two, we want to be able to be here to take care of you, and if we're all sick, that doesn't work at all. Keep in mind, RMDs, they're optional for 2020. We will be reaching out to you over the spring and into the summer to find out where you are with those. Do you want your RMDs? Do you want us to stop them? We will not automatically stop them just because they're optional. And so those of you that are on auto RMDs, meaning they're happening automatically, we are still going to reach out to confirm that you want that money coming out, because here's an opportunity to not take money if you don't need it, because RMDs for many of our clients mean we're just paying tax on money that we don't particularly want. We're just being forced to pay tax on it. We're also going to talk about Roth conversions. Do they make sense? How are we going to pay for them? Where's the break even? So we're going to continue that conversation that we've had in the past. We want to talk about your risk, because I would tell you that 2/3 of you haven't picked up the phone, 2/3 of you haven't called us, but the 1/3 that have called us, that are worried about things, that have voiced those concerns, what that raises to Ryan and myself and the team is that perhaps, even though we've talked about this, perhaps you're taking too much risk in your portfolio now, because if this made you nervous, then we need to reevaluate that. And that's true across the board. We always, every year we talk about how much risk we're taking and is it the right amount of risk. So we're going to continue to talk about that. We're going to make sure the income sources are doing exactly what we thought they're supposed to do. And again, for the most part, we think we're right on target with these things, so we're pretty comfortable. But we want to make sure you're just as comfortable as we are. Tax preparation continues. Keep in mind, tax returns are not due until July 15th. That does not mean you should wait until July 15th to get me your paperwork. Get it into us as quickly as you can, because as we open back up and we get busy again, you will be in the head of the queue instead of at the end of the line. So better to get it in now and let us get to it when we have time to do them, rather than wait till middle of June to send them in, hoping that we get them done in time, because it's entirely possible that we push them out into September and October. Also, your estimated tax payments, April's estimated tax payment is not due until July 15th. If you owe money to the federal or the state, it's not due until July 15th. But the June 15th estimated tax payment is due June 15th. So from a cash flow point of view, you do need to pay attention to the fact that you could have a June 15th payment, a July 15th payment, as well as owing money to the IRS and or state of Maryland on July 15th. So just from a cash flow point of view, please take that into consideration. If you're thinking about retiring soon, obviously you want to keep your risk as low as possible. Make sure your income sources are safe and secure. You should have some sort of written plan to make sure you're never going to run out of money. If you have cash, if you're sitting in cash now, think about DCAing back in the market sometime in the next month and look at that list of stocks that you might like to play with, just to somewhere to go. Things to remember, we know the markets go up and down. It's just the nature of the beast. If you're going to be in the stock market, you have to take the good and the bad. It's just the way it works. Remember, we use the fixed index annuity to avoid those crashes and bear markets, but they come with strings attached. But they're getting that same 5 to 6% rate of return. I'm not suggesting that you should use an index annuity in lieu of the stock market. I'm just saying for most of our clients, we've used an index annuity for part of our positioning, and that part has been safe and secure during this whole mess. For people that are taking withdrawals from the stock market, you need to have about a 3-year cash reserve. So whatever you take from the stock market, you should have 3 years sitting in cash. And I say 3 years because 2000 to 2003, that was those 3 years. 2000, 2001, and 2002, that's 3 years. 7, 8, and 9. Well, 7 and 8 were disaster, and part of 9 was a disaster. We have this year. It's not going to be good. And even though 18 was fine, even though 19 was fine, 18 was a mess. So you need to have 3 years worth of cash sitting aside so that during these downswings, you can take money out of your cash accounts instead of the stock market, so you can actually give it that time to recoup, because that's the only way you're going to make it. If you have questions, obviously give us a call. Our number's right there on the screen. If there are questions that you guys have, anything you want us to discuss right now, I had a couple questions that I see here, and I'm going to try to read them as best I can. Company I work for filed a loan on the first day in 4-3, and we were approved. Here it is, 10, 11 days later with a 2-week funding time. Yep, that fits the basically the month that I said that it takes. That fits exactly. So that's good to hear that somebody agrees that that's exactly what I had. What we said. So estimated taxes, because somebody's asking me to just repeat that. Estimated taxes. So normally they're due April 15th, June 15th, September 15th, and then January 15th for the fourth quarter of the prior year. So April 15th estimated taxes are not due until July 15th. So if you're paying estimated taxes, if you can pay them, go ahead and pay them now, but you do not need to send them in until until July 15th. So June 15th, you'll have an estimated tax payment due. July 15th, you'll have April's estimated tax payment due, unless you've already paid it. And then your tax return itself and any payments resulting from your tax return need to be sent in on the 15th as well. Anything else, guys? Anything else? Any other questions before we wrap up? Oh, here we go. Statements. Let me see this. Why was so much on our accounts for being inundated with statements? All right. So one of the questions just came in, and this is a good question. When you became a client of ours, and we sent you information on setting up your accounts at Charles Schwab, we set your accounts up at Charles Schwab to give you electronic notice delivery. So we set you up there. If you went into Charles Schwab and agreed to receive electronic notification, you're not getting 10,000 pieces of paper. But every time something is bought or sold, every time something changes at Charles Schwab, they send you paperwork. Now, we've always encouraged our clients to get the their tax statements on paper. But everything else, as far as I'm concerned, can come electronically. And what they'll do is they will notify you electronically that you have all this stuff, and if you want to go look on it, you go click in and look on it. If you don't, you just ignore it. But the solution to so much paperwork, getting so much paperwork, is to get on the phone and talk to Brian, and Brian will help you go into Charles Schwab and tell them to stop sending you all that paperwork and to just electronically notify you when it's available so that you can go review it at your time and you don't have to open up 8,000 envelopes every week. Now, the reason why you're getting those is because every time we buy or sell, not only do they have to send you the buy and the sell of a position, but they have to send you a prospectus related to that buy and sell. It's absolutely insane. It's just a regulation that's out there. But, some years, like 2018, we didn't do a whole lot of buying. 2019, we didn't do a whole lot of buying and selling. 2018, we did some buying and selling. So some years you get a bunch, some years you get hardly anything. The solution to that, though, is to get those things all done electronically. I'm trying to read this paper, watch so much activity when saying the course. So the question is why aren't we just buying and hold? We don't buy and hold because we don't believe in buy and hold. We think buy and hold works really well when the stock market's going up. We think buy and hold is a horrible idea when the stock market's going down. In 2000 to 2003, that proved to be true. 2007 to 2009, us getting out of the way of the stock market meant our clients recovered sooner. And same thing as even here, that the stock market at one point was down 35% when our clients were down 17 or 18. And if you look at the total portfolio, our clients were down, 10, 12%, and the stock market was down 30 to 35%. And you think you had heart attacks when you were down 15 and 20. Think about the heart attack you'd have when you're down 35. So Ryan and I don't believe buy and hold works when the stock market's going down. We think, mom told me when I was really young, don't fight the undertow when you're out in the ocean. Don't fight against it, and don't try to just ride it out because you won't ride it out. You need to swim sideways to get out of its way, and that's the philosophy we've always taken. We try to minimize the downside. We try to minimize the downside to make sure that we are not losing as much as the overall stock market. Another question is that then this is sort of a statement about why is it that we consider the and I'm having a hard time reading these and I apologize. But the question has to do with why do we consider the annuities as part of the process? Because if we actually did a traditional allocation in your portfolio, you would have, and I'm making it up, 60% stocks and 40% bonds. And so when the stock market was crashing, our bonds would help offset it. So if that's what a traditional allocation would look like, and I don't care what the allocation is, you're always going to have some sort of defensive positions in there. There's always going to be some sort of bond, commodity, something like that in there. And for us, we're using an outside source. So when you look at the overall performance of what we're doing, that's how we interpret it. That's how we look at it. Now you can choose not to, and certainly that's a conversation that can be had. But that's how we look at it. Because again, normally when you have a normal portfolio that would have some percentage of bonds and some percentage of stocks in it, you would look at the whole portfolio, make the decision, am I doing well or not, based on the entire portfolio. And so we don't segregate out just one piece. We look at the entire thing. Here we go. So $1,200 is a $1,200 from the as a taxable event. It's not a taxable event per se. What will happen is the way it's been explained to us, the way we've seen it is on your 2021 tax return, there'll be a spot on there that says, did you get the credit? And did you get the $1,200? And if you didn't get it for whatever reason, then they'll put it on the tax return as a credit there. So it'll reduce your taxes by the $1,200 there. So from what we have been told and what we've been able to see and read, it is not a taxable event for you. Are the losses on our accounts tax deductible? To the extent that they are in a non-taxable account, I mean, to the extent that they're in a taxable account, like TODs and those type of things, they will not be, they'll be deductible. So non-qualified money is deductible. Taxable, I mean, tax-deferred money, IRAs, Roths, they're not deductible there. Let's see. Okay, yes. Anybody who has questions or anything like that, please feel free to call the office and set up a time. You know, there's several people that ask for that. Please, you know, I know you say, you know, call me. I'm asking you, call the office, set up the time. When it's convenient, you can call the office and leave a message, whatever it is. But if you want to have a conversation, a virtual conversation, we can have that conversation. I think that's it. Any other questions before we wrap up? I think that is it. Anything else before we wrap up? Thank you so much for joining us today, folks. Give the office a call. 866-597-1040 is our toll-free number. I'm sorry, that just comes from the radio. This comes off automatically. But 410-863-1040, 410-863-1040. And I see a couple people here. I will leave a message for my staff to give you guys a call. Take care.